Hello everybody. For those of you who don't know me, my name is Fred Burke, also known as the Wholesale Mentor. What I'd like to do in this video is go over an article titled "The Feds Tighten Up Lending Rules" from CNNmoney.com. The central bank is proposing regulations that offer greater protections for home buyers and curtail abusive lending. This is by Gian Sahadi, CNNmoney.com senior writer. The Federal Reserve proposed a much stricter set of rules for mortgage lenders as part of the central bank's effort to avoid and avert abusive lending. Some of the rules would apply to borrowers with what the Fed called higher-priced mortgage loans, which it defined as first lien mortgages that carry interest rates 3% points higher than the yield on comparable Treasury securities, basically subprime loans. Another set of proposals would apply to all mortgage loans. The rules are subject to public comment for 90 days, after which the Fed will review comments and consider whether to make changes to them before issuing final rules. The subprime plan. Our goal is to promote responsible mortgage lending for the benefit of individual consumers and the economy, said Federal Reserve Chairman Ben Bernanke. Said, "We want consumers to make decisions about home mortgage options confidently with assurance that unscrupulous home mortgage practices will not be tolerated." The Fed's proposals would prohibit giving people unaffordable loans. The new rules would bar lenders from extending credit without considering the consumer's ability to repay. One reason for the spike in foreclosures among those with subprime adjustable rate mortgages, also known as ARMs, was that lenders measured a borrower's ability to repay the loans based on the low introductory loan rate, but not on the higher rate that the loan would reset to. The Fed proposed the lenders base affordability on a borrower's ability to repay the loan at the reset rate. Restrict use of liar loans also. The Fed wants to restrict the use of so-called liar loans or stated income loans. So the days of stated income loans and no docs, it seems, are over, guys. When lenders make such a loan, they don't verify the income of the potential buyer. The end result, home buyers end up with homes they never could afford in the first place, let alone when their rates resets. It is now insisting on verification both on borrowers' income and assets. Will also prohibit or limit repayment penalties. Homeowners who want to refinance into more affordable loans are often prevented from doing so because of punitive prepayment penalties, which can amount to the equivalent of 6 months of mortgage payments. The new Fed rules require that lenders waive any prepayment penalties for 60 days prior to a loan rate resetting. Require or encourage escrowing of taxes and insurance. Subprime lenders often do not disclose the true cost of a home. They might have excluded home insurance and property taxes, for example, nor did they collect taxes and insurance along with the mortgage payment and hold them in escrow for the borrower until they came due. Across-the-board changes. Some of the Fed's proposals would apply to all types of mortgages, not just subprime loans. Curb or better disclosure broker incentives. To encourage brokers to bring in more business, lenders can pay a broker to lock in customers to higher rate loans than they'd otherwise qualify for. For example, a lender might pay brokers 1% of the loan amount for every half point of interest added to what's known as the per rate, the rate the borrower would qualify for based on their credit score and other standards. This incentive is known as the yield spread premium. Lenders impose prepayment penalties on borrowers as one way to ensure the lenders make back the yield spread premium they paid. The Fed would now prohibit indirect or direct payments from lenders to brokers unless brokers disclose to the borrowers the compensation they expect to receive from all sources, including the yield spread premium. Prohibit coercion of appraisers, lenders, or mortgage brokers under the new rules will not be permitted to exert undue influence on appraisers to misrepresent the values of homes involved. In the past, appraisers have often been pressured to overvalue homes if their selling prices are higher than what appraisers think they are worth. Prohibit loan servicers from engaging in unfair practices. The Fed will require that a servicer credit a consumer's account with payment as of the day of receipt and provide a record of payments within a reasonable period of time after it is requested. Late fees could not be pyramided, that is, changed more than once. Require better disclosure overall. The Fed proposed rules to address incomplete or misleading mortgage ads and to require earlier and clearer disclosures by mortgage lenders so that consumers can avoid loans that are not in their interest. An example of a prohibited advertising practice would be the use of the word fixed to describe a loan in which the interest rate or payment is not fixed for the entire term of the loan. The proposed rules also state that all applicable rates and payments must be given equal prominence with advertised introductory or teaser rates. Lenders could not advertise a lower interest rate than what the loan is actually accruing. That would mean an end to claims of loans with 1% interest rates when the rate is actually much higher. The 1% usually refers merely to the minimum payment consumers are required to make. Each payment made at that level means the balance owed on the mortgage grows. From the Fed to the Hills, some members of Congress, which is considering legislation that would crack down on mortgage lenders, have blasted the Fed for not acting sooner to avert the mortgage mess. The Fed was given the power to issue rules to clamp down on abusive mortgage lending in 1994 under the Home Ownership and Equity Protection Act, called, I guess, HOPA, H-O-E-P-A. HOPA authorized and directed the Fed to issue rules to address unfair mortgages practices. For 13 years, that authority sat on the shelf unused, said Rep. Brad Miller, Democrat, North Carolina, who co-wrote the mortgage lending abuse bill that passed in the House in November. Where the provisions in the Senate and House bills overlap with that the Fed calls for, Miller said it's possible they would be removed from the bills under consideration. Maybe we won't fight the same battle when, where we've had substantial victory, he said. One community advocate, John Taylor, chief executive of the National Community Reinvestment Coalition, said more needs to be done. The proposed rules are not a substitute for strong anti-predatory legislation, he said. Some lawyers panned for Fed's actions. Some lawmakers panned for Fed's actions, The Fed took a significant step backwards today, said Senator Christopher Dodd, D. Connecticut. The board did not even have the courage of its convictions. The board weakened its earlier guidance on requiring an originator to fully analyze a borrower's ability to repay the mortgage at the fully indexed rate, the most fundamental measures of good lending. In addition, Dodd said the Fed's proposed steps on prepayment penalties were inadequate and said the Fed should have banned the use of yield spread premium entirely. Representative Barney Frank, D. Massachusetts, said the Fed's move is confirmation of two facts we have known for some time. One, the Federal Reserve System is not a strong advocate for consumers, and two, there is no Santa Claus. People who actually are surprised by one are presumably surprised by the other. A low interest rate of 396%. Senate OK's prime bills, A bills, Senate creepy from city to burbs, no free ride for subprimers, Fred ride mortgages in your rate, so on and so forth. I thought this is an article you guys may be interested in, so I figured I'd go ahead and I'd pass it on and make a video out of it. Until next time, we'll see you then.